All right, let's get right into it. Every single week, 8:30 a.m. Eastern, the US Unemployment Claims report drops. And for a lot of people, that's just a signal to start gambling. But not for us. Today, we're breaking down what's called the operator protocol. Think of it as a professional framework to turn this super volatile event from a total money pit into a structured, real opportunity. We're not here to guess the number. We're here to trade the market's reaction to it. So you gotta ask, why do so many traders get absolutely shredded on this report? Well, it's pretty simple. They trade the headline. They see a number pop up, their emotions just go haywire, and they dive headfirst into that chaotic first move with zero plan. They get caught in these violent swings, whipsawed by algorithms, and end up chasing a move that was never even real to begin with. That's the literal definition of gambling, not trading.
And that's exactly where the operator protocol steps in. It's all about a mindset shift, moving from that chaotic headline-chasing world to the calm, controlled world of professional execution. The whole goal is to give you a clear, behavior-proof process.
Now, this is what I think is really the heart of the whole system. It's this core concept called binary legality. In this system, every single trade you take is either 100% legal, meaning you followed every single rule to the letter, or it's illegal. That's it. There are no gray areas, no kinda, sorta. This isn't about whether you were right or wrong about the direction. It's all about disciplined execution. And that one principle, it just completely rips the emotion out of your decision-making. So what's the difference? What makes a trade legal versus illegal? It's dead simple. A legal trade is always led by bond yields. We're talking the 10-year Treasury yield, that's ticker TNX, and then it's confirmed by the price structure you see on the chart. An illegal trade, well, that's when you're just reacting to the stock futures moving by themselves, or you're chasing that first crazy headline spike. So here's the bottom line. If the bond yields aren't playing ball, the move in stocks is illegal. You don't touch it. Period.
Okay, let's get into the first actionable phase, the pre-flight checklist. Between 8 and 8:25 a.m., this is where you define your battlefield before the first shot is even fired. Your preparation here involves 3 non-negotiable steps. First, you've got to mark your key levels, the highs and lows from the overnight Asia and London sessions, the volume-weighted average price, VWAP, and of course yesterday's value area high and low. This basically maps out your key zones of support and resistance. Second, you define your structural bias. And third, you just verify the liquidity to make sure the market is actually healthy enough to trade. All right, now for what is maybe the most important 10 minutes of the entire event, the kill zone. From 8:25 to 8:35 a.m., that covers the 5 minutes before and the first 5 minutes after the release. Your only job is to do absolutely nothing. You are an observer, you are not a participant. And the rules here are incredibly strict. No new trades, no adding to positions, no trying to fade the initial spike. You are completely hands-off. And this illustrates a key filter that will save you so much pain. If that first 5-minute candle is just a massive wild bar, we're talking bigger than 0.6% of the asset's price, the entire event is deemed untradeable. You just walk away. Seriously, that one rule alone will save you from blowing up your account.
So the kill zone has passed, the crazy volatility is contained, and now you're ready to actually look for an entry. How do we spot a high-probability legal trade? Well, it all comes down to a very specific sequence of confirmation. This right here is the chain of command, and it is absolutely non-negotiable. First, and this is the most important part, bond yields, the TNX, have to move decisively. They are the true driver. Second, the equity index futures like the S&P 500 or ES and the NASDAQ NQ, they must follow the direction of the yields. And finally, you need key sectors like the financials, XLF, and tech, XLK, to confirm that move. If this sequence is out of order, or if even one link in that chain is missing, there is no trade. Let me just say this again, because it is the single most important rule in this entire protocol. If you see stocks ripping higher, but the bond yields are just sitting there flat or even falling, that is a fake move. It is an illegal signal specifically designed to trap retail traders. This is your ultimate filter. It's what will keep you out of so many bad trades. So, once your drivers are all aligned, you look for that final piece of visual proof right on the chart. This could be something like the price dipping below a key level and then getting bought right back up. That's a sweep and reclaim. Or maybe it's a really clean breakout that then finds support, which confirms it wants to continue. Or you might see a breakout that immediately fails, signaling a potential reversal. Okay, so you're in a legal trade. Great. Now we have to shift into management mode. And we do that by classifying the market's response into one of 3 distinct scenarios. Think of this as your decision matrix. It's your playbook. If you get alignment, that's where yields, futures, and the price structure are all moving together in harmony. You play for continuation. If you get a break then fail, where that initial move just fizzles out and the yields reverse, you start looking for a potential fade trade in the other direction. And if it's just flat or nothing, the market is choppy, yields are quiet, the action is simple. You do nothing. You stay out. Finally, let's talk about the safety net. These are the final checks and hard rules that filter out the lower probability setups and, most importantly, protect your capital. A great strategy is completely useless if you don't have airtight risk management.
These are your edge filters, the last questions you ask yourself before you even think about entering. For instance, are we trading outside of yesterday's chop zone or value area? Did we respect that kill zone volatility rule? These checks are designed to make sure you're only putting your capital at risk in the most favorable environments. If the environment is poor, you stay out, even if a setup looks tempting.
So this is a really crucial point about professional discretion. What happens if the structure looks okay, but it's not perfect? You don't just skip the trade, but you also don't go all in. You reduce your trade size by 50%. This keeps you in the game, but it acknowledges you have lower conviction and you're actively managing your risk. And these are the hard rules, the ones that are never, ever broken. You never, ever add to a losing position. You never re-enter and chase a trade after it's already failed once. And you have a hard maximum stop on your losses for the day. These are the rules that prevent one bad decision from snowballing into a disaster.
So after all these rules and filters and procedures, how do we boil it all down into a guiding principle that you can actually remember when things are moving fast? Well, it comes down to a simple mantra.
This is it. This is what you need to repeat to yourself. Trade the structure, not the number. That means ignore the headline, read the chart. Equities are illegal without yield participation. That's your ultimate filter. And finally, the process. Observe during the kill zone, confirm the drivers in the structure, execute only the legal trade, and then manage the outcome.
And that's the operator protocol for the unemployment claims report. It's a clear, actionable plan that forces discipline, structure, and professional-grade execution. So really, the only question left is, when that next report drops, are you going to be a gambler just reacting to the noise, or are you going to be an operator executing a plan? The choice is yours.